Good afternoon, everyone. I think we start interaction for this afternoon session. I'll introduce the panel. We have Mr. Kannan, MD, SBI Caps. We have Mr. Bansal, Chairman, Corporation Bank. Mr. Sarkar, well-known face for a long time. Mr. Batra from IDBI. Rahul Banerjee from Standard Charter. Mr. Pradeep Kumar, Deputy MD, State Bank. Balesh from IDFC. And then we have Mr. Ramnath from McKinsey. Before we start interaction, broadly this session is for 75 minutes. And this, with the cooperation of all, I would suggest that around 10 minutes can be given initially to McKinsey to making a set up the presentation for infra financing. After that, towards the end, we'll have around 15 minutes of question answers. And we are left with around 50 minutes. So on average, around 6 minutes time for each, for which, as agreed by all of us, we will have some theme to speak on for each speaker. Now I invite Mr. Ramnath to speak. Make the presentation, please.
Thank you, everybody. Esteemed members of the audience, esteemed members of the panel, audience. The word infrastructure today actually evokes a lot of emotion and not always positive in these times in the financial system. For a variety of reasons, I think the sector has gone through a fair amount of stress over the last 2-3 years. I think a combination of internal and external factors. But nobody can actually doubt the importance of infrastructure to driving economic growth in the country. And just to put it in context, 4 years back, the proportion of investment to the GDP was to the level of 40%. Based on the recent statistics, that number has actually come down to 31%. This is the total investment, gross capital formation to GDP, which effectively means that we have lost around $100 billion of investment, which can actually be used to funnel GDP growth. And I think that just puts it in perspective in terms of what the role infrastructure can actually play among that entire investment pool in really kickstarting and turbocharging economic growth. I think with that in the backdrop, what we wanted to do is step back a little bit and really look at how the evolution of infrastructure has been over the last decade and more recently over the last 2 years. Talk about the future in terms of, what will it really take in terms of funding India's infrastructure requirements? And more importantly, what are the concerted set of actions which need to be taken, both by the policy makers, but also by institutions individually as well as collectively, to really help us realize the potential of this particular sector. I think these are figures and statistics which you may be very familiar with. Over the last 10 years, actually the Indian economy has seen remarkable growth in terms of infrastructure, physical infrastructure creation, whether it's real estate stock, whether it's port capacity, whether it's air traffic or road stock. And I think that's also kind of been commensurate with, dramatic increase in revenues as well as profits of infrastructure players. Almost 10x, 50x increase over the last decade, both in terms of, at least in terms of revenues, and a 10x increase in terms of profits. Over the last 5 years, there's been close to $400 billion which have actually been spent on infrastructure, around half of which has actually come from the government. But the rest has actually come from a combination of banks, NBFCs, the insurance sector, external borrowings, as well as funding through equity by the developers and the promoters, both internally as well as with external FDI funding. Right. On the flip side, however, I think the value creation story for the infrastructure sector as a whole has been pretty doubtful. Right? If you really look at pre-crisis and post-crisis, pre-crisis, clearly the infrastructure-related sectors were among the most value-creating in terms of total returns to shareholders on the stock market between 2000 and 2008. But these are the sectors which have actually taken the maximum beating post the economic crisis between 2008 and 2012, which has actually contributed to the entire sense of pessimism and gloom about the industry. If you really double-click and analyze what's really been happening out of the total plan spent in the infrastructure sector, in the 11th plan and the 10th plan actually before that, what we see is that there is dramatic variation across different sectors. There are sectors like oil and gas, for example, or there are sectors like telecom, where the achievement against the intended target has been significantly ahead of plan, 30% higher than target there. But obviously, there are also sectors like ports, there are sectors like electricity, where the achievement has actually lagged targets significantly. And this actually has been a combination of several factors which have actually been seen in the economy, precipitated by some of the policy logjam in terms of being able to complete projects, also in terms of shift in the economic environment. The other thing which has actually happened, which is a factor which I think India is quite different from the rest of the world, is the role and the relevance of bank borrowings in funding infrastructure in India. If you look at the borrowings by the top 10 infra groups between 2007 and 2012, that's increased by almost 5x. The total of cumulative borrowings of around $100 billion in the banking system just to the top 10 infra groups itself, which has been growing at a compound annual growth rate of more than 40%. This compares to a normal banking credit growth of almost somewhere around 15 to 16%. Surprisingly, this is shockingly, this is actually equal to almost 98% of the entire banking system's net worth. And all the companies' major investments are actually infrastructure, whether it's GMR, GVK, or some of the other developers which you actually see today. If you take a forward-looking view, what we actually find is that the 12th plan has made estimates of more than $1 trillion, which actually is expected to be invested in infrastructure over the next 5 years. Estimates are that the total shortfall, and I think there are various estimates which many of you would have seen, the total shortfall in terms of what will be required to actually fund that gap is anywhere to the tune of $120 to $240 billion, right? The bulk of it will actually come in terms of the budgetary support, which is around $100 billion. But a significant part of it will also come in terms of expectations from banks, NBFCs, insurance companies, as well as ECB, equity, and FDI. And this is, by the way, based on normal assumptions that there's a base case which will actually be met in terms of funding from these sources, which itself is a questionable aspect right now, based on how the infrastructure sector has actually been progressing. I think if you really look at what the situation in India today is in terms of funding and financing sources, across all the potential sources of funding and financing which actually exist and which is prevalent in multiple markets, there are very few which have actually been actively used in India today. Project loans, both from banks as well as development financial institutions and likes, continue to be the largest component of financing. But as we talked about, there's huge stress on assets. There is direct equity which is playing a role, but a lot of other sources of financing such as CDSs, securitized assets, tradable debt funds, have not really seen traction or takeoff in the context of the Indian market. And just to kind of put it in perspective, if you compare China's funding source versus India's funding source, out of the non-budgetary sources, close to 40% of the non-budgetary funding is actually coming from commercial bank, 20% of the overall and around 40% of the total non-budgetary funding. While on the other hand, if you actually look at China, significant part of the overall funding is actually coming from internal accruals as well as self-raising funds and others, right? And that just gives you a context. If you compare it with markets like Malaysia, for example, a significant part of the funding is actually coming from the corporate bond market. Similarly, in markets like more developed markets in the West. The other thing, if you actually put it, is the traditional pools into infrastructure, whether it's the pension funds, it's the life insurance companies, or the sovereign wealth funds, are underinvested in terms of their allocation to Indian infrastructure. Less than 1% of their overall allocation of these pools is actually been seen both in 2005 and in 2010. I think one must acknowledge that over the last 3 or 4 years, or particularly the last 2 years, the government has taken a number of positive steps, particularly to actually remove bottlenecks in infra financing. Whether it's in terms of relaxation of ECB norms, whether it's in terms of the entire takeout financing deal between IFCL, LIC and IDFC, the formalization of the guidelines for the infrastructure debt funds, as well as several steps towards actually building a positive and robust bond market. I think there is much more which needs to be done to actually get out of this kind of a logjam which we are in at this point of time. And these measures and actions, in our view, need to be at 2 levels. One is there are some clear set of policy actions which actually need to be taken. Policy actions in terms of how do you actually develop sustainable and viable credit enhancement mechanisms, particularly in terms of, ensuring the uptake of the CDS structures, as well as evaluating potentially creation of monoline insurers, which we've actually seen in a number of markets to actually provide credit enhancement to this particular sector. The second one is in terms of continued efforts to actually deepen the bond market, whether it is actually reviewing the guidelines both for the pension funds as well as provident fund, the pension funds and insurance sector for investing in it, with actually reviewing the MTM norms for the banks to actually invest in the bonds, as well as in terms of how do you actually get more FII investment in. And finally, I think there is clearly a role for more specialized financing institutions and alternate sources of financing to really fund Indian infrastructure. I think there have been several positive steps being taken in the direction, but there is much more which needs to be done, particularly in terms of the role of securitization and some of the others. And I think we've seen from markets, for example, like in the US, where credit enhancement provided through monoline insurers have actually played a very, very important role in activating the bond market, right, which is a very significant contributor to the overall funding of infrastructure in that particular country. And a very similar setup has actually been seen in a market like Malaysia, where more than half of the overall private infrastructure funding is actually coming from private capital issuance through corporate bonds. In addition to policy-related roles, I think there are also a deliberate set of actions which the players, both individually as collectively, can consider taking to really accelerate and participate in this business viably. And this ranges from really putting in place robust credit risk management systems, right from appraisal to, more importantly, early warning systems, having a much more systematic approach towards workout and restructuring. An important part is how do institutions actually play a much more active role in the operational activities of the investee companies or the funded companies, right? Particularly in terms of, can they put in place best-in-class processes for actually time cost reduction, where we've seen that there is a 15 to 20% opportunity possible in terms of actually, improving the operational efficacy of some of these projects. And finally, I think there are also some industry-level efforts which can be considered in terms of, sharing of data among players, as well as, joint efforts in terms of workout and restructuring. Clearly, there's a lot to be done. I think the opportunity immense. The rest of this panel will actually talk about some of the types of actions and ideas which different participants can actually take to really activate this particular market. Thank you once again for your patience.
Thank you, Mr. Ramnath, for really setting the tone. Broadly, we all are aware that infrastructure not only contributes to growth, it also brings in inclusion. Because there are larger users, it improves the quality of life. And we have seen the China model that if the investment in infrastructure is there, then growth is much higher. And accordingly, in our 5-year plans also, in 10th plan, we were investing around 5% in infrastructure. Then in next plan, we invested around 7%. And for the 12th plan, we are likely to invest around 9%. So this increased investment in infrastructure calls for substantial improvement in giving funding, solving policy issues, also addressing sector-specific issues, and creating newer markets. And as well as whatever is existing, improving the processes. For instance, he talked about risk framework. Credit has to be based on risk assessment. Pricing has to be appropriately there. In this direction, there are lots of issues. So first of all, I would invite Mr. Bansal, who is chairman and who has worked in IFCL also earlier on deputation from Dena Bank, that what are the issues which are there, which are particularly linked to infrastructure financing. Thank you.
Yeah, thank you, Mr. Bhanwala. As Mr. Bhanwala rightly said, the requirement of infrastructure are very high. And during the current 12th 5-year plan, as we are aware, over $1 trillion of investment is envisaged. Out of this, around 48% and over is to come from private sector, as against 37% last 5-year plan. But recently we see that interest of private sector is somehow waning, and it looks like that infrastructure story has ended. So far, banks were the major driver of infrastructure funding. If we recall, in the year 2000, there was merely rupees 72 billion funding by banks, which increased over 100 times to 7,860 billion rupees in March 13. This, shows a annual compounded increase in funding by banks to over 43%. At the same time, when this funding happened, the NPA and restructuring also happened, and banks' impaired assets have increased to over 17% as on March 13. Why it has happened? When we analyze the reason, we find that partly banks are also responsible. Starting from 2000, in our drive, in our, getting the balance sheets increased, size of balance sheet increased, we have funded very liberally infrastructure projects when we were not having the capacities. for appraising the infrastructure projects. We mainly dependent on the, these syndicators and appraisers, and we just followed without going in the due diligence process and other things required for, appraisal of infrastructure funding. Developers are also equally responsible because in spite of knowing that the biddings are aggressive, they just bid when they were not having equity in the hope of getting equity either from private players or going to the market. They just went project after project and now they don't have equity. Some of the projects are stalled and banks are also equally having problems when the equity is not coming from the promoters, they are not able to finance. Third thing is that governance issue. Because of the governance issue, like land acquisition problem, coal blocks could not be developed, environmental clearance took more time, stoppage of gas supply from KG-D6, and state discoms funding even interest payments by borrowings. All these three things led to the stress in the infrastructure sector, and now we have to see how to go ahead.
Thank you, Bansal Sahab. Highlighting some of the issues which are intrinsic to an organization and some of the issues which are external to it. Broadly, we can say that in infrastructure, the policies were evolving during the last decade. We had the initial PPP model being framed in this country, only in a limited number of sectors, maybe primarily in road and maybe to some extent in power. But the definition of infrastructure is really large. The recent definition lists around 21 sectors. And of those 21 sectors, if you look at the concession agreements, the model concession agreements, the statutory authorities to give out projects is still evolving. Also, we have limited number of developers highlighted by him. All these problems have led to a situation of stress. I think stress has to be tackled by the financial institutions. Also, because of the fact that we have larger regulatory eye on the financing being done for infrastructure sector. Also, the fact that the regulators have not conceded to the request that infrastructure be treated preferentially in terms of provisions, etc. So, with all this, I would request Mr. Batra, who is sufficient, one of the largest banks is IDBI for infrastructure financing, to take on the measures, and also particularly because of the fact that they are also, the undertaking, the overall leader for restructuring is being done by IDBI. I request you. If it is not working, I'll share my mic with you.
Well, my friends, thank you, Dr. Bhanwala. Dr. Bhanwala, our friends from the McKinsey and Mr. Bansal have highlighted most of the issues. I'll mostly try to confine myself to, how we can address the current stress in the sector in the short term, as also what perhaps we need to do in the medium term so that what has happened can be largely avoided. It's very rightly mentioned that a lot of investment has gone into infrastructure already. The figures were mentioned by Mr. Bansal. In terms of percentage, over the last 13 years, if we look at data, in terms of percentage of gross bank credit, the outstanding credit to infra has grown from 1.7% to nearly 13.5%. Now, that is only fund-based credit outstanding. And I know that a lot of commitments are undisbursed. They are still there. They are not added to this figure. Plus, there is a lot of exposure in terms of guarantees and LCs which banks have taken part of the blame has to be shared by us bankers also for the situation we find ourselves in as far as the problems in infra are concerned. But I would like to be more charitable to our banking community, because if banks were not there, especially public sector banks were not there, infra would not have reached where it has reached today. We also saw in the presentation as to we have gone from where to where in terms of various sectors. A lot of development has taken place. You know, in a period when you are evolving, Dr. Bhanwala mentioned that infra story is evolving. You cannot remain static in your approach to things also. Your approach also has to change, evolve, and adapt to the emerging situation. The country has been growing at a rapid pace, and it has been trying to overcome a large backlog of infrastructure. And it has been supported, I would say, almost single-handedly, with little support from here and there by the banking community. Therefore, we must give credit to them for having taken the burden this far. But today, when we see the stress around us as a result of several factors, including, of course, you know, certain things that we thought were right, but in hindsight, they have not turned out to be right. This is a time when we perhaps can pause, have a look at what we have done, how we had done, what are the lessons, and how, therefore, we should move forward. I think the immediate problem before all of us is to address and tackle the current stress in several infrastructure companies. One figure in the presentation came that 75%, nearly 75% of the infrastructure projects have not been completed on time. Less than 25% have been completed on time. 75% of the projects, if they are not completed on time, the implication is they'll be cost overrun. In terms of interest during construction, in terms of inflation on the inputs which go into implementing the project, and also in terms of delayed realization of revenues which were planned to be used by many of our friends elsewhere. So it is actually having a cascading effect on several areas of not only the developers' plans, but also of the bankers. What we need to do is to really support. In one word, I would say that there is no other option. Not because you know, there are you know, other avenues for recovery, but I think the kind of sizable investment that has gone into infrastructure, the first response of each one of us has to be how to retrieve this investment, how to make it productive, how to make it going, how to make it completed. I think government also has been working in that direction, and that is the reason why so many stalled projects are on the top of the agenda of the central government, and they are being very closely monitored and facilitated. As bankers, we also have to play our part. When 75% projects are having time overrun, they are having cost overrun as well. Therefore, I think it is the collective responsibility of all those banks who have funded those projects to handhold them and to give them need-based support. If it is cost overrun, we need to really pick up the bill to the extent it is our responsibility. And also, to the extent it is the responsibility of the promoter and developer to make him, you know, foot his part as well. We are finding a tendency, I wouldn't say that it is too widespread, that just because a problem has occurred in a project, some of the banks, they're raising their hands and saying that no, I mean, we cannot any longer give money, whether it is for, you know, filling the gap or whether it is for, you know, funding over an assistance. I think that needs to be relooked at, because if one bank or two banks, you know, don't do what is their share, then the rest of the banks also shy away, delays occur, and promoter may not be having sufficient money you know, to fill even the other bank's gaps, and therefore, you know, the problem gets compounded. The other issue is that of restructuring. I think
wherever restructuring is needed, it is being done. But I think the issue is to do it timely. If you don't do it timely, the basic assumptions of restructuring change. And therefore, you need to do more. And that is where we find that many of the cases which have gone through CDR or earlier restructuring, they revert with a rework. That's something avoidable if we respond a little more timely. The third thing that I'm keen to mention is that at this juncture, when some of the projects are close to completion, one can also look at the option of refinancing. Refinancing is something which can be done by the existing set of banks, new set of institutions as well. I'll close by pointing out one more issue broadly, which was hinted at by Mr. Bansal as well, that when we went into this financing, we perhaps did not fully understand the concept of risk allocation. The risk allocation, the way it has happened in our financing, has been entirely topsy-turvy. Most of the risk of these projects has been carried by lenders, and much less has been carried by the developers and the promoters. That risk equation, that risk allocation needs to get corrected. How to do that? I think it will get discussed as we go along. One of the ways is to sort of bring in more equity, to restructure the responsibilities and covenants, but details we can discuss as we go along. Thank you very much.
Thank you, Mr. Batra. State Bank is a large bank and they have sizable exposure to infrastructure financing as well. And when we require almost 22,000 crores in the 12th plan, and with a gap of around 5,000 crores still to be made up from somewhere else, I think, and also Mr. Batra rightly said that there is a stress in the banks on account of infra financing. Do we need some kind of newer structures, mechanisms? For instance, we have recently seen Prime Minister's Office Project Management Clearing Group. Or do we need something else? I invite Mr. Pradeep from State Bank to speak in this regard.
Thank you, Dr. Banwala. Good afternoon to everybody. This morning, the Honorable Finance Minister said that he's drawing a red line on his fiscal deficit. That very clearly indicates that the government investment in infrastructure is going to be minimal. So I think the entire burden of building the infrastructure or financing the building of infrastructure will come on the private sector. Now, if you analyze why did banks financing infrastructure, it was because the 3 DFIs vanished or converted themselves into other institutions. The service economy of the country was growing very fast, which did not require bank finance. So banks gravitated towards financing infrastructure. It was easy in one way because it was lumpy, much easier to handle, centralized. We don't require a large number of people spread over like a bank like us, 15,000 branches. So a small group can handle, brought efficiencies of scale. But of course, all the problems Mr. Batra said has come along with it after a decade. So what do we do? My view is that we should go back to the DFI model. I know that they are not going to replace the banks, but we require more institutions. We now have IFCL, but very small institutions compared to the need of the country. We have some sector-specific institutions like PEC, REC, PFC and all. But I think the time has come back to go back to the old model. Maybe IFCI, which is now a small NBFC, can convert itself into a DFI. And just a thought. Maybe there's a need for multiple DFIs. If the government investment in infrastructure is going to be minimal and the entire funding has to come from the private sector, I think we require more institutions. That's, I think the most important thing that is required. Yes, but banks will continue to be part, even if a couple of institutions come, banks will continue to be a part of infrastructure lending. Mr. Batra was talking about restructuring. I just quote an example of one loan we financed when I was in the US. It was a hotel. We financed it jointly with HSBC in the initial stage. How was the loan structured? There was a 3-year construction loan at a particular rate of interest. Then there was a loan for another 2 years when there was no repayments envisaged, because that was the period when the business will build. There was another rate of interest for that. Then a 25-year loan, 25-year repayment period, for which initially HSBC said we'll finance for 5 years. So effectively HSBC said we finance the 3 year of construction, 2 year of moratorium, 5 years repayment, and the balance 20 years after that you will have to refinance. And this is the model they asked other banks to participate in. SBI also participated. I think it's time for us to introduce this model in this country. Because banks only finance infrastructure, we have landed up with short repayment periods, amortization periods of within 15 years. And which, as Mr. Batra said, 75% of the projects getting delayed. There's a need for restructuring. Restructuring is coming at a large cost to the banks, the NPV loss, then sometimes some funding of interest. All this contributes to the banks, affects the bank's bottom line badly. There is obviously, especially in the smaller of the banks, I think there's a great reluctance to restructure. So I think we must now go to RBI and tell them we must adopt this model. Refinancing model is the way out. We have banks cannot fund for 20 years because of their ALM mismatches. We have to go to a model where, yes, we'll have a longer repayment period, but each bank can take its choice. No? Like this HSBC said, they'll be there for the first 10 years, 3 of construction, 2 moratorium, first period of 5 years. SBI also has agreed only to that model. They said we will not go beyond 10 years. I think this model has to come. This is the way forward to finance infrastructure. I think all of us have to join hands together, go to RBI and get this change. Now IFCL does a takeout finance. Like your commercial banker like me, when does it do a takeout? After there's cash flows in the project. When the cash flows in the project have started coming, my risk is coming down. Will I be willing to give away the exposure? I believe, as Dr. Chakravarti said, it should be the other way about. The DFIs should finance during the construction and the initial moratorium period. The banks can come in later when the risks are much lower. Of course, I don't know whether Dr. Harsh agrees with me, because I'm saying that the model should be the other way around. Rather than he taking out from me, I must take out from him. Couple of other thoughts. Of course, the corporate bond market is not very well developed, but even if developed, I think there are a lot of regulatory restrictions on insurance companies, provident fund and pension funds in investing. Most of the large projects will get rating below the investment grade. Most of them are SPVs. They'll get rating below the investment grade. And in the current situation, current regulations, I do not think the pension funds or the provident funds or in the insurance companies are able to invest in any of these bonds. So some regulatory changes by the other regulators like IRDA and PFRDA is also required to enable us to take financing infrastructure to the next level. Banks, as I said, have to continue to fund. Banks have a huge asset liability mismatch because most of our funds are short term. The government, banks again are the biggest funders of infrastructure today. But many so-called infrastructure companies are allowed to raise tax-free bonds. Banks are not allowed to raise. I think this also has to change. Banks should be allowed to raise long-term tax-free bonds. This will also enable the banks to finance for a longer period, if they are willing, if their the ALM mismatches per permit. This way they can reduce perhaps the ALM risk in the balance sheet. Thank you.
Thank you, Mr. Pradeep. You rightly indicated some of the newer mechanisms and structures which can come up, and let's see if DFIs come back. That's a suggestion he has made. But it's a fact that something new is required to be done for infra, to reinvigorate it. Either it has to be newer products, it has to be newer areas, newer sectors, so that we continue to keep funding the foundations of this nation. I invite Mr. Kannan, who is the MD of SBI CAPS, one of the largest arrangers, syndicators, to speak on newer avenues, newer processes, newer products for infrastructure space.
And thank you, Dr. Banwala, and my fellow panelists and people on the dais. I'll just take over from what Mr. Pradeep Kumar mentioned, my senior, who also took the advantage of speaking before me and take some of the points which I thought I'll speak. In continuation, what I'm saying is the normal life of a project, infrastructure project, is 25, 30 years. And as you rightly put it, the financing done by the banks are 12 to 15 years max. So why should we have this entire repayment coming upfront? Why not have it distributed over the period of 25 years? Then will come the issue regarding the ALM mismatches. So the pattern which is being adopted by in the US, where the financing is initially for a period of 6 to 7 years, and thereafter it's refinanced. A balloon amount repayable on the 7th year is refinanced every 5 years at a time. Maybe by means of a loan or by means of a bond, because once the project is on stream, it becomes very attractive, so it becomes tradable. That way, the nomenclature of a NPA or restructuring, the fear of restructuring, especially after 1/4/2015, can be avoided, and we can have a scenario where it becomes a performing asset because it's actually performing. Of course, it's not performing, then the particular company which is having it will carry it in its book. This particular aspect we had discussed, as he was mentioning, we had taken up the matter with the Reserve Bank and the governor himself. And he was saying, yes, it's an excellent idea because he has come from the US. He clearly appreciated it and he said, yes, this is something which we can look going forward. The infrastructure bonds are not very attractive. Especially the banks are permitted to issue infrastructure bonds about 7 to 8 years, but not very attractive from the banks for the purpose of funding. So maybe we can find some relaxation by way of CRR, which can make it more attractive because the rates could be quite good, but because of the CRR, the effective cost becomes much, much higher than the normal rates. So this is also something which we have flagged, and I feel that this could be a really good source of a long-term funding of 10 years and 12 years. Of late, you have the PSUs, which have raised tax-free bonds. In fact, tax-free bonds are so attractive, almost giving about 12% pre-tax rates. But I think even the banks would be in a position to raise it. And if some relaxation by way of CRR, instead of tax-free, they can have a CRR, maybe the rates could be much better. This would ensure that they can get some real long-term funds. Companies have been raising foreign currency bonds in the infrastructure area. And believe me, with no forex flows, say in the power or road, one wonders as to how they're going to meet the forex risk. A suggestion we made was an agency, maybe including Reserve Bank of India, as it did in the case of, say, IMD, or provide a forex option. It sells an option at a particular premium with a depreciation of per year of, say, 1 to 2%. This way, any foreign currency bonds, if it becomes a part of the project financing, the banks are also comfortable that forex risk beyond a particular thing will not be there. And that will be factored in while doing the appraisal. These foreign currency bonds, even the foreign people also will be comfortable that the banks, the companies would be in a position to meet the forex risk as it has already been factored in. Urban infrastructure has not been talked about. Most people have not done this. But there is something called the municipal bonds, or what you call the muni bonds overseas. Of course, the first name which will come to our mind is the Detroit muni bonds, which failed. But that could be a one-off scenario. A lot of corporations in India have the need to do a rapid urban infrastructure to increase the quality, but lack funds. But they do have what is called regular cash flows by way of taxes, etc. But they need a lot of upfront. So municipal bonds can be issued by these municipalities or the corporations, which is permitted. But the issue comes with rating. Maybe institutions like IFCL or others can do a credit enhancement and give a rating of AA plus, thereby getting these bonds to be subscribed by institutions at very, very competitive rates. So you have the urban infrastructure also growing because of clear-cut taxes which can be escrowed into accounts and ensure the repayment of these bonds. LIC and pension funds are one of the players with real long-term funds. In fact, I think if most of the Indians take up insurance policies, I think 40 to 45 years could be the type of funds they have. Therefore, they are rightly placed to take part in this kind of infrastructure funding. But they have some limitations on the total amount which they can take up in each project. I have already been warned that I am, because of some time overrun, I'm not supposed to do. Hopefully, it's not rescheduled the entire thing. Last, but just one more point which I want to make a mention is regarding the pricing of the bonds. Corporate bonds are a problem because of the pricing being skewed. The poorly rated companies at A and below get a much, much finer pricing by way of loans as compared to the bond market. Internationally, the bond market actually is priced slightly better than the loans. But in India, you find the AA and AAA rated bonds are very finely priced, and the bonds hardly are taken up for A rated and BBB and others. But the loans are so finely priced that there's no incentive for anyone to raise these bonds. And last but not least, the corporate bond market not taking off is the MTM issue. Maybe it could be addressed in case the loan market is also similar. I don't want to further reschedule the entire time and hand it over back to Mr. Banwala.
Thank you, Mr. Kanan. In fact, newer areas, newer products is a very vast field. I know an entire session can be there, but our limitations, we took cap it in 5-6 minutes. We have by and large spoken on restructuring on asset side, but at the same time, we require concession periods are longer in long-term nature, 30-35 years. We need long-term resources. And we have an expert who is on from raising of resources. I'll invite Balesh from IDFC to speak on the requirements of raising resources for infrastructure and also IDF. This is a new initiative for offering some succor to infrastructure projects. Yeah. Balesh.
Sure. Thanks, Mr. Banwala. Hello, everybody. See, one of the oft-repeated excuse or reason given why banks cannot fund infrastructure is the whole asset liability issues, because traditionally banks fund themselves to short-term and short to medium-term deposits, and lending happens very long, especially in infrastructure, very long period. But given that infrastructure is one of the key areas where investments are going to go in the next at least more than a decade, and given there is no alternative, as Mr. Pradeep said, given the absence of financial institutions, development financial institutions or otherwise, banks are going to continuously funding infrastructure going forward also. And therefore, what it has created is some level of asset liability issues, because banks have been funding long term, but structurally on their asset liability side, nothing has changed. Their liability profile has remained the same, and asset profile has moved much longer. So one of the few things that needs to be done is essentially banks have a relook. While a lot of people say, there is this argument about how long is CASA. There is arguments both ways. Somebody says CASA is short, but there is a stickiness to CASA. Same way there is a stickiness to working capital, therefore matures. But having said that, I think there is definitely a need for banks to relook liability side in terms of how can they raise long-term funds. While few examples have been quoted in terms of tax-free bonds or long-term infrastructure bonds, I think there is definitely a need, because today there are different competing availability for a retail investor to invest. I'm talking about purely financial investment. I'm not talking about physical investment that retail savers are doing today. Actually, increasingly, the retail saving is moving towards physical, and that's the reason Governor has been on day one saying that he wants to incentivize retail savings to bring them back into financial markets. So I think one of the things that banks have to definitely look at how to increase their long-term funding. The various options could be banks raising, while RBI has given some flexibility for banks to raise long-term bonds if they have infrastructure exposure more than 5 years, but also there is a need to freely allow banks to raise long-term bonds in the bond market, both domestic and overseas. It helps both ways. One of the reasons why corporate debt market beyond certain maturity is not really growing is because there is also lack of issuers. Today, if you look at the corporate bond market, there are not more than 5-6 issuers who can issue bonds. Beyond that, it's dead. Bringing in banks into the long-term bond market will definitely help giving investors a diversity. I talk to a lot of these foreign institutional investors who invest in India. More often than not, the complaint I receive is, look, I don't see more than 5 guys to issuing bonds. Where are the other issuers? Why can't we get more issuers? I think, therefore, there is a need to allow. I think there are some, regulatory issues, but I think we need to relook and really allow long-term, bonds to be issued by commercial banks, both in the domestic market and international market, so that which will help them to elongate their liability source. Secondly, a lot of my co-panelists also mentioned that, there is also, given that there is this huge need for infrastructure investment, there is also need for providing some amount of fiscal incentives for raising long-term resources. It need not necessarily be tax incentives. It could be other incentives like, for any bonds or, deposits raised beyond 5-7 years, you can have some, SLR CRR, you can reduce SLR CRR requirements or anything. But, we need to come out with solutions to help banks to raise long-term liabilities. Same way, looking at the asset side, typically Indian banking system has been a buy and hold investor, infrastructure or otherwise, they buy the asset, hold the asset, and given the borrower's ability, get themselves refinanced or otherwise. I think there is a need to slowly, banks at least have a relook in terms of how they churn their portfolio, especially in the asset side. See whether they can really create a small secondary market for loans in the domestic market. Internationally, if we do a loan, there is a free secondary market where one bank can sell the asset to other bank. In India, we need to slowly create it because that will help to reduce bank asset profile because after 3 years, 5 years, they can always sell to buy some other asset. We need to create a small, at least in a small way, secondary market for loans. People spoke about corporate debt market, but I don't want to, really get into that. The other way is essentially the infra debt fund. I will briefly touch upon infra debt fund because infra debt fund could be one more session we can talk, eternally on that. See, infra debt fund can, as you all know, can be structured either as a mutual fund or an NBFC. To talk about NBFC, while there are few people who have set up IDF in NBFC format, unfortunately, I think it's going through both banks because, but for two reasons. One is the timing at which IDFs have come into play, and secondly, there are structural regulatory issues. The timing, the reason why I say is, if infrastructure sector is growing the way it has been growing in the last 5-6 years, banks would be happily selling their assets because they see opportunity to put out more assets. But unfortunately, it's a time where the sectoral issues have created NPLs and also the credit demand and therefore the credit demand from the sector has come down, and therefore banks are today reluctant to sell assets to IDF. And secondly, also I think one of the things we need to look at is in case IDF refinances a bank asset, it becomes senior to other senior lenders. There is an issue in terms of seniority of lenders when IDF refinances. I think that's one of the big bottleneck the way I see it in terms of IDFs going growing in a big way and going forward, and therefore there is a need to even relook that and allow maybe IDF to be pari passu to other senior lenders. Then I definitely feel at least NBFC format will grow, IDF in NBFC format grow in a decent volume because that is definitely needed given the sectoral funding requirement. On the mutual fund, it's the same thing. There are some structural issues which we can discuss during question and answer session, because I think time is running out. Thanks a lot.
I think by the time one warms up, the time gets over. I think whether it is for the respite of the people or otherwise, after lunch session is a little difficult one. Still, your enthusiasm was great, and you warmed up to IDFs. It's a big topic. But at the same time, we can at this juncture consider looking at the perspectives from abroad. How infrastructure, what are the financings done abroad in brief? What are the issues there, what structures, which are not present in the country today? And also, can we have some capacity creation within our own institutions, on lines with some of the foreign institutions for infra financing, specialization or otherwise, because this is a lot more different than what is the normal financing. I invite Mr. Rahul, please.
Thank you, Dr. Bhanwala. I think one of the things that the foreign investors who are looking at infrastructure financing in India would really like to see being allowed in a more liberal manner is something that IIFCL and Dr. Bhanwala have created and have worked on, which is the credit enhancement. So what I would request him is, after I finish speaking, if for a minute or two he could speak about the credit enhancement. From moving on from there, what the foreign investors can give is they are used to doing very long-term financing. Mutual funds overseas have shown interest in doing 30-year financings. It is common to hear about a dollar bond that goes out 30 years. Likewise, using the ECB route, people are able to come in and finance at a relatively lower dollar cost. One of the unfortunate problems that has happened is when the infrastructure companies that have borrowed in foreign currency have not hedged. And with the rupee depreciation, it has added to their woes. So what started out as a good thing and a positive thing turned out to be a negative in hindsight. That learning is easy to implement, that if you borrow on foreign resources, but you don't have a dollar hedge, please do consider hedging it. The need for taking genuine credit risk is something that the foreign lenders are capable of taking. However, I think we have seen the lead has come from the Indian institutions. And it is there that the structures like credit enhancements can slightly bifurcate the financing at a low cost with credit risk and appropriately paid credit risk going to an Indian institution who is better positioned to understand and implement that solution. I think measures that Balesh spoke about, like SLR, CRR, qualifying for infrastructure asset. I'll also broaden it. Another option could be if some of these bonds could classify as the priority sector lending, the infrastructure bonds. But once again, with the corporate bond market, we have seen historically the default rates in the INR corporate bond markets have also been close to zero. The flip side of that means that the corporate bond investors are today unwilling to take very large credit risk. And even if I believe that relaxations are done, allowing PFs and insurance companies to invest, we will not see a large uptake, except in those projects which have stabilized and are backed by cash flows to get a high rating. Some of the things that can be done is if the cap on ECBs is relaxed, if the pricing cap for mezzanine and sub-debt we discussed in our pre-discussion, that can allow another form of riskier capital to come in. Because at the current cap level, the subordinate debt or mezz debt structures are not possible because of the demand for a higher risk premium. Put options being put on to the onshore company for the offshore investor would allow them to consider an exit in case the project gets delayed. That is something that I think for good reason has been prohibited, but it is, as we go out and meet foreign investors, it is a demand that they sometimes raise. I'll stop on that aspect. I think the institutional knowledge and expertise is the need of the hour. Just one aspect of that, how to manage the ALM itself for, as we saw this summer, is in itself a long drawn process which requires a lot of understanding and expertise. The legal expertise for understanding the contracts for resolution. It will take quite a bit of investment through every institution to create the knowledge which can then be used to creating a better risk-reward structure for everyone. With that, Dr. Bhanwala, maybe I'll request you to talk a little bit about the credit enhancements, which it's your sort of area of expertise.
Thank you. I think if there is any question later on, because we're running short of time, but basically it's a mechanism to enhance your ratings so that you can draw from the capital markets or the bond markets and can raise long-term money. I think we have taken a pilot project forward, and the issuance is going to be there. It is held up primarily on account of the fact that the bond market today is in bit of not a stable, not in stability, whereas comparatively the pricing of loans, which is not, was referred to by Mr. Kannan in his speech, is not primarily on account of risk. There are factors in terms of relationships and others which weigh in. So the loan costs are not as high. As a result, nobody is as at present interested in pitching in for a long period in the form of bonds. But it's a good concept, can be carried forward. I think now I would invite in the end, most seasoned, I'd invite Mr. Sarkar to not only summarize of what we have discussed. He has been a seasoned banker for a long time, but also he's got his own views on infrastructure financing. Mr. Sarkar, please.
Thank you, Dr. Bhanwala. And certainly, I think this topic is very big, but only the time is very short, and there is no question of restructuring or extendence of COD, I think. So there is no question of time. So my job certainly become really easier. Actually, here the combination of all the bankers we heard about, and being a banker for more than 3 decades, we have just graduated ourselves in the various type of lending over a period of last 3-4 decades. We are the commercial banker, now we are converting to the project financer or the project finance banking. My friend Mr. Batra is there from IDBI, he was their project financer, but now they are converting it as a commercial banker. So I think just we are trying to just imitate our expertise in the other field, and just we are sharing each other that what are the constants and what are basically you can share with. Here I feel that, okay, the presentations by Mr. Ramnath is quite exhaustive. So in that case, the issue is that, okay, how really this 5-year plan, that is 2012 to 2017, that which is required about US dollar 1.3 trillion, and how it be financed, whether you should go for some Malaysia model, China's model, or mixed model. The basic thing is coming out of it that, okay, the infrastructure necessity is completely needed at this moment in each and every sector. Real estates are developed, mining is required, power is required, road is required, telecom also phenomenal development there. But the budgetary resources are not sufficient, so how we can really look into the various sources about it for the funding, that is a great challenge for it. Mr. Bansal started that, okay, this bank has really done a good job, and thus entering into, whether we are knowingly entered into this infrastructure or unknowingly, but bankers really had developed that, okay, we can also be the partner for this infrastructure financing for the development of our country. Whether good or bad, certainly the future will list, but we are also very much criticized in the market that how many restructures in the pipeline. Really you are expertise enough or expert enough to go for this type of financing. Certainly bankers are also trying to be expert that, okay, how it can be really to go for this type of finance. So criticism will be there, and when some criticism is there of the bankers also, I feel we are the right line. Maybe that some triggering is required, some fine-tuning is required, that I do feel as a banker. Restructuring, certainly I think we are asking about this, some norms we can certainly approach to the regulators. I think that is a big issue. But restructuring, the reason for that, okay, it is not only the finance. The question is the eco-clearance, input linkage, and there is land acquisitions, all other issues are there. So it is not only the regulator can solve, I think the government agency also should come forward. And it is not to hand. I think the bankers certainly will be needed to get the help of this government agency in the various sectors. My friends also suggested about the municipal bond. I think it has tried level-based earlier also, but I think it did not succeed. Rating is a big issue. And even the municipal corporations also, they are having their own other problems there. Recently, with the government guidelines, we have restructured about a lot of ACBs. But the future will tell on like how really it react, what is this question of the power tariffs revisions. So certainly all the future will be responsible to give this answer that, okay, whether we are in the right path or not. But I think that, okay, slowly, we are getting some maturity and understanding. I think that will help us. The another question that, okay, that lot of, that infrastructure projects, what Mr. Batra was telling, that 75% is not completed in time. So cost run, time overrun, cost overrun, I think it is not being reflected also in the restructuring proposal itself. The another thing came that, okay, the governance issue, I think equity raising is one of the issue. We feel that, okay, sometimes the equity is coming in such a way, but it is nothing but a debt, and is coming in the various tiers, and ultimately, whatever the water is flowing from the Ganga in Benares, we think that whether it is the drain water or rainwater, but it is known as a Ganga Jal or Ganga Pari. So I think that, okay, we have to really differentiate that, okay, which are the debt content, which are the equity content, and before any project, I think it should be clear that, okay, how much resources in form of the equity should come. We are agreeable for the, okay, 20% sufficient, but that should be the genuine equity, not in the other forms. I think that is also what happens. The others, promoters are really facing the problems in the servicing about it. The another issue the promoters are always telling about that, okay, they are not getting the payments in time, or some sort of this, maybe that is the government agencies or some other agencies. I think that also need to be streamlined that, okay, before the revenue start, how the really flow about it. Whatever this projects we are going for the 25 years, some internal review is very much needed. Whether we are going for this, any appraisal by the, any of the appraisal company, but I think some internal review is needed after a few years, which is presently lacking, I understand. It is not the question of the review of facility over a period of time. I think the whole review of the project is needed in the present context. Maybe the power, maybe the road. I think that is very much needed. I think another point was telling about the foreign currency bond with various options. But the question is that all the infrastructure projects are generating the revenue in the rupee terms that I do feel. So in that case, hedging is an issue. When presently the RBI is telling that, okay, hedging is necessary, whether we are having the natural hedge, how much it should be quantified, that also is a question, but at the same time, I think that is a great challenge, that, okay, how we can really insulate ourselves, that, okay, we are taking the loan maybe because of the low rate of interest, but how really it can be addressed in course of time. Another point, I think Mr. Bal is also telling that whatever the crux is the things that, okay, raising of the resources of the various sources, maybe the tax-free bonds, all other alternatives are there. But I think bankers also having a role to play in one sense, that, okay, whenever the tax-free bonds is coming IRFC, so IRFC fund is going to all railway project. Power finance is issuing infra bonds or the other tax-free bonds, money is going to the power sectors. Bank is also investing there. So I think we have to just think a role that, okay, whether we'll go for the direct financing or the indirect financings. If this be the case, the bankers should be really allowed to go for some tax-free bonds so that we can directly participate for it. I think there's a big question, big demand also. So what happens, we are not really today, our respected FM was telling about the segmented banking. I think that is the need of the country at this moment, because we are all crowding in the same market. So either we are going for the tax-free bonds, maybe the tax-free bond, maybe the individual can go for some trust can participate there itself. Why all our banks are going together? I think that is a big question to have think about, that we are too much crowded in the same market. And last thing about that was telling about the SLR, non-SLR status or the private sector status. I think there's a lot of discussion is going on about which will the private sector, but I don't know which sector will define, but it is a priority, and it is a priority finance that is needed. I think time is very short, I think. As I told that, okay, there is no question of further extension of time and no resettlement. And I think that, okay, some of the questions of my friends may be there itself, and we can just little bit take for some time. And speakers already told, and it's a really mixture, and the inputs by all the bankers is a huge contributions, various contributions in the various angles. I think all the intelligent friends here could assemble themselves. So my job role is, I think it is over. If something is there, I can contribute. I can I can tell something about. Thank you very much.
Thank you, Mr. Sarkar. We have around 9 minutes with us. I would invite some couple of questions, maybe 3 or 4. Yes, please.
Please give the introduction also so that we can reply suitably.
Umang Gupta from IDBI Bank. Mr. Kumar sir mentioned about the refinance model specifically. What I want to discuss is, isn't there a need for an insurance or a guarantee fund on lines of CGT MSME for the same similar model for the infrastructure, so that whatever methods we adopt, whatever things we do, they are more secured, they are more backed up by something. If something fails, there is one thing that is CGT MSME or something like that helping us on the backside. I'd like to discuss on that, please.
If you see world over, insurance is given for very high risk small loans. I don't think for these huge project finance of loans that there can be insurance at all.
Being the government on the side, anything can be insured, I think. So.
It's huge amounts. Let us say you lend 10,000 crore to a project. I mean, what will be the insurance fee?
I think IFCL is doing that now by way of credit transfer.
No, I would only say that we are, in case of a bond issuance, we are giving guarantees. That is not a reinsurance, but it's a way of guaranteeing to a certain extent. But we are also, it's on a pilot basis. And that too we are giving partial guarantee, so that it gets enhanced to a level where it is people can put in money, because people will put in money on the investment grade material. And SPV doesn't have net worth and has issues of other kind. So to help them overcome that, we have some guarantee mechanism. But insurance the entire loan amount is a little tricky one. But at the same time, we ask the project developer to insure all its assets as a loan covenant, as a loan policy.
Okay, thanks for the reply.
Thank you.
Yeah, my name is Madan from Care Ratings. See, I think Mr. Pradeep Kumar raised a very interesting issue about bringing DFIs back. But I mean, I fully agree with you. I think when ICSI and IDBI got converted to universal banks, the whole ethos of long-term lending actually came to an end. Now, quite interestingly, today we know that even something like IDFCs applied for a banking license. So is it a case of saying that at some point of time, maybe IFCL will also probably say that maybe infrastructure financing is not the right thing, and getting into commercial banking is probably the better thing? I mean, is there kind of a drift because there's an inherent problem with
First of all, as of now, we don't meet the net of 10 years. We are only 6 years old. And as of now, we are a Government of India owned company. 100% Government of India owned company. And IFCL, the mandate is primarily for infrastructure and primarily for long-term financing. So, not for short-term financing. And as a result, we have taken some initiatives for elongating our repayment periods for developers so that some succor is available. As of now, the government doesn't think that we should become a generalized bank. Right now, the government thinking is, because we have all the eminent government functionaries on our board, and when we interact, they want us to continue. And rightly said by Mr. Pradeep also, that the DFIs need to play a larger role. So as of now, we don't see any momentum on that kind which you're talking about.
May I supplement? You see, perhaps the answer may or may not lie in reverting to DFI model, but you know, the new licensing guidelines, they do permit differentiated licensing. That's what in the morning FM was also referring to, that we should not have clones. So in the context of infrastructure financing, perhaps we can think of two broad categories. One, those who know appraisal well, and therefore, who can finance projects up to COD. And then the rest, after the risk of completion of a project is over, the risk changes its color and it comes down also, and therefore there should be a separate class to finance. It could be run-of-the-mill commercial banks, or it could be even separate institutions. So therefore, broadly, I think the answer lies in, one part of work being done by one set of institutions who are specialized there, and the other part by the other after COD.
I am Jairam Bhatt from Karnataka Bank.
Any more questions?
Yeah. I am Jairam Bhatt from Karnataka Bank. This is on restructuring of advances. Recent master circular from RBI appears to be slightly defensive on percentage of provisioning for restructuring, 5%. then fair value provisioning, FITL and all that, it all amounts to almost 10% to 11% of provisioning for a restructured asset. Don't you think that it is very, very harsh? And should the bankers do something in representing the Reserve Bank? And also, when the restructured assets is taken back to the normal assets, even the conditions put there is also very defensive, stating that even if the borrower pays promptly the interest also, we cannot transfer it to the regular assets. Then only once the principal is paid for 1 year, then only it has to be transferred to the normal structure. So, as bankers, can we represent to the Reserve Bank about, because infrastructure advance is one thing which is a priority, and can Reserve Bank do something on that?
I'm glad you are speaking in our voice. Actually, not that we have not been representing to RBI, but RBI as a regulator has its own views and concerns. They don't want to encourage restructuring for restructuring's sake. And recently, in recent, I would say, quarters, the concern has been that there has been a rush for restructuring, and even the undeserving ones have tried to force into CDR and other restructuring mechanisms. So to make restructuring costlier, perhaps has been one of the intent of RBI in issuing those kinds of guidelines. But still, I think the point is very valid because in a bid to shut out the ones who are undeserving, we should not be shutting out which are deserving as well, and increase the cost of restructuring for the banks. So we are in, I would say, dialogue with the Reserve Bank, and government also seems to have taken this cue. I was looking at a report day before where the ministry also says that there should be differentiation between reschedulement and restructuring. Where it is for reasons not attributable to the promoters, there should be a different regime, there should be a different regimen which should get considered by RBI. Let's hope they listen to this.
I think Batraji, IB has informally taken up with the RBI governor. Yeah. They have taken up.
Any other question, please? We have somebody there. One last question from there. Last question. That there was an arm. Somebody raised that arm in the end there.
Hello, can you hear me?
No.
Yeah. This is Radhika here from Business Line. I just had one question. We were talking about banks being allowed to, issue tax-free bonds like, other public institutions like PFC and REC. And as someone rightly pointed out, we know that, if the bonds are issued by PFC, then the funding goes to power projects. In case of banks, how do we ensure that if they do get the, they are allowed to issue such bonds, it will ideally eventually go to, infrastructure financing, because you do have, other attractive avenues within the whole entire lending space. So
I think certainly that is possible, because if really we are raising some sources, because my all other friends also raised this issue of ALM. For the bank's own sake itself, we can allocate these resources in that directions only. That is possible, and that governance is certainly existing in the bank. It can be earmarked, and that is not impossible to us. It's very feasible things. Thank you.
I think the bank's infrastructure portfolio is 13% of its loan book. So I think there's a huge, whatever we raise will be a very small percentage of that.
When you are getting the resources for 1.5 year average, and we are allocating these resources for the 25 years, why not the reverse of the case? We are getting this, we can match very appropriately that fund.
I think with this, apologies, we can discuss separately because they are signaling that the next session is there. I think we thank you all for hearing this session, and we can have outside this room also some discussions can flow in. Thank you very much for hearing us.
Okay,
Thank you.
before we